Good afternoon, everyone, and thank you for joining us. Welcome to the Dialogue Series session. I'm Anjal from the AASB. The Dialogue Series is held jointly with CPA and CAANZ. The topic for today is the changing landscape of carbon offset disclosures in annual reports, and the session will be chaired by AASB Research Director, Dr. Eric Lee. Please note that the views shared in this session are not the views of the presenter's organization, but their personal views. Also, you're welcome to ask as many questions as you like using the Q&A function, and we will try to answer as many as we can if time allows. With that, I'll like to hand it over to Eric.
Thanks, Anshal, and hello, everyone. So my name is Eric Lee. I'm the Research Director at the AASB. Joining with me in the presentation is Deborah Wan from the AASB, and we're going to first start with the presentation for about 15 minutes, and then we'll join with our panelists to give their perspectives on and their insights about this very topical topic that is the carbon offsetting issues. So with that, I'm just going to ask Anshal, would you please share the slides so that we can all see the slides, and I'll go through some of the here you go, here it is. Okay, so this dialogue series we'll discuss carbon offsets and why sufficient disclosures of carbon offsets in annual reports are important for entities. As I mentioned, we will start with the presentation and then follow with the panel discussion. The next slide, it is a slide that provides a background about what carbon offset is. Before I go on, just want to check, Anshal, would you be able to click on the next slide, thanks? Hopefully it works. Oh, let's start again. Here you go. Thanks, Anshal. So what is carbon offsets? Put it simply, in general, a carbon offset is a way to compensate for carbon footprints. The typical examples in the Australian market are using carbon credits to offset carbon emissions or using renewable energy certificates to do so. However, there are many questions whether these carbon offset mechanisms are effective. Investors have also started asking a lot of questions about whether these carbon offsetting mechanisms are truly valuable for an entity and whether it actually meets its purpose. So in this presentation, Deb and I will use carbon credits as an example of carbon offsets and discuss how companies report their use of carbon credits in their annual reports. So next slide is a very simple illustration on the life cycle of carbon credits. And generally, entities will start by estimating the greenhouse gas emissions, and then they should develop some strategies to reduce those emissions. And after companies have done everything they can do to reduce the emissions, they might still have some leftover emissions, and this is where carbon credits come in. They can be used to offset these remaining emissions. So this cycle demonstrates how carbon offsetting and carbon credits work together to help entities manage and reduce their overall carbon impact. Next slide is some of the concerns that we have heard in recent years. Firstly, it is newly regulated. It is questionable about its effectiveness in reducing carbon emissions. The price of carbon credits can be very volatile. The verification of reduction of carbon emission from projects are challenging. And of course, disclosures can be complex. The market has been asking questions, how should carbon credits be treated in the financial statements and how to be reported outside of the financial statements. So with that, I'm now going to hand it over to my colleague, Deb, to share a research conducted by the AASB research team and with the help from Dr. Eka Tan from Deakin University. Deb, I'm going to hand this presentation over to you.
Yep, thanks, Erica. Next slide, please. So in terms of the research that was done, just to give you a bit of a snapshot, is we looked at the top ASX 50 companies And as you can see from there, they cover quite a wide range of industries. In terms of how information is presented, it's actually quite interesting because the majority of companies actually already prepare a separate sustainability report to their annual report. And when I say annual report, I mean that nice thick glossy that you get at the end of every year. So with most companies actually doing a separate ESG report to their annual reports, this concept of connectivity or integrated reporting, which some of you might be more familiar with, that concept becomes actually really important because it's about making sure that information that's useful to users of one or the other or both reports, that kind of information is flowing through. And it's really important that we see that narrative flow. If you just go to the next slide, please. So in terms of what we looked at, we searched for the term carbon offset and carbon credit to see who actually mentioned that in their annual reports or their separate sustainability reports. Of the 50 companies that we looked at, 32 companies mentioned carbon offsets or credits in their annual reports. Of the companies that did not mention it in their annual reports, they did mention it in their separate ESG report. So that's telling me two things. So one, of our ASX 50 companies, everyone is talking about carbon offsets or credits in one way or another. But there is a proportion of companies who are talking about it, but that in their separate sustainability report, but that information is not necessarily flowing through to the annuals. If you go to the next slide, please. And so narrowing that the research even further, what we found then was actually looking in the annual report, if you look at the financial statements, only a small proportion of companies were actually mentioning carbon offsets or credits in their actual financial statements. So that's their balance sheet, their P&L, and the notes accompanying the financial statements. So while we had 30 companies mentioning it outside of the financials, only 6 companies actually mentioned carbon offsets or credits, both within their financial statements and outside of their financial statements. So what we're seeing there is while a lot of companies are talking about carbon offsets and credits, for some reason, possibly for materiality reasons, that information is not necessarily being called out in the actual financials. If we go to the next slide, please. And then in terms of what companies are actually saying with regards to carbon offsets and credits outside of the financial statements, what we found was that there's actually quite a wide range of information that's being given. So it's not like there's a particular checklist which companies can use to say this, this, and that. It's actually quite a wide range. Some companies talked about, okay, we have plans to purchase or retire, so how they plan to use them. Some companies made statements about how many they'd purchased during that year. If you go to the next slide, please. Some companies made just statements that actually said, we're not going to use carbon offsets, carbon credits and offsets, fair. And then some companies also said a bit more vague along the lines of, we're just going to use these if we actually think we need to use them. So quite a wide range of information that's being provided. And I think that's what that's telling us is, especially in the context of the mandatory climate-related reporting that's going to be coming into effect from 1 January next year, we're going to have to be quite critical about what information is going into our annual reports or our sustainability reports, because we must look at them through the lens of, okay, what are we saying and is this information useful to our stakeholders? And especially if companies are already in the habit of saying something, there's an added layer of, well, is there more that you can be saying as well? If you can go to the next slide, please. So in terms of what's going to happen next, so as we said, we looked at the top ASX 50 companies. That sample population is going to be expanded, and the numbers will obviously be updated from there. The AASB is going to conduct more outreach and consultation with stakeholders. So that will be both in person and through online webinars. So there will be an invitation to anyone and everyone to sign up for those sessions. And we really encourage everyone, as many people from diverse backgrounds, to sign up and have your say. And the reason why we say this is because the findings of this research is also going to be used to inform the AASB and the ISSB at a global level. So it's a really great opportunity to, if you have a really strong views or opinions about these kinds of disclosures, to have your voice heard about it. Thanks.
Thanks, Deb. I hope that gave everyone a good setting of what the discussion is going to be like today. So now I'm going to start a panel discussion, and before that, I'm going to introduce our panel members for today. First up, we have Martin Lawrence, who's a director from Ownership Matters. We have Fiona Manning, who is the manager of ESG engagements in climate from the Australian Council of Superannuation Investors. We have Tara Oakley from Oceania South Pole, who's the regional director of South Pole. We have Cameron Matthew, who's the acting general manager of carbon credits from Clean Energy Regulator. So welcome everyone to the panel discussions. So maybe we should start with the very first question, and I'm going to ask Martin and perhaps Fiona this question. That is, as you are the users of financial reports, what is your experience so far with the disclosure of carbon offsetting? Have you got enough information? And do you have any particular information you would like to see from the current practice? Maybe Martin?
Thanks, Harry. I suppose I'm not surprised by the findings of the research that Deborah just outlined, in that you don't often see carbon credits, carbon offsets mentioned in financial statements. And where you do see it at companies like Rio Tinto or Woodside or BHP, it's reasonably clear why you don't often see them. It's because they are not material. They do not pass the materiality threshold. As an example, I think BHP has an accrued liability under the safeguard mechanism at 30 June 2024 of 17 million US dollars. In that those are ACCUs it must buy and surrender to meet its obligations under the scheme. In the context of BHP, 17 million is not even in the ballpark of materiality. But I guess one of the things that I take heart from in seeing this disclosure bob up in financial statements, particularly at companies that are climate exposed, like have high exposure to carbon constraint risks, is that at least it means you can be certain that they exist. Because at the moment, financial statements are the ones that are subject to audit and review and are under a kind of an agreed set of looking at the world. That is coming in the sustainability standards, but we don't have that yet. And so it's just that when a company says, hey, we have all these carbon offsets that we plan to use, seeing them in the financial statements gives you some certainty that, yes, you do in fact have them.
Thanks, Martin. And Fiona, did you have the same experience as Martin?
Yeah, I'd say like generally the disclosures I've been seeing are pretty underwhelming, and backed up, I guess, by AXI's own research. We do an annual report on climate-related disclosures of the ASX 200. And this year we found that although about half of those companies reference the use of offsets as part of their climate strategy, very few actually disclose how they'll be used, or have been used, and what types are used. So I think it was about 20% of the ASX 200, so 40 companies disclosed how many offsets had been retired, sold, bought, or generated. And of those that said they had bought or used offsets, around 22 companies actually disclosed the type of offset that had been used. Generally speaking, same as Martin, very few mentions in the financial statements. I see mostly qualitative statements in the sustainability-related disclosures, which reflects what you found in the research. I mean, for most companies, the dollars involved in relation to offsets are not huge, but for some companies, there is a very material amount held or used. And for all companies with a net zero plan, which is about 94% of the ASX 50 and around 2/3 of the ASX 200, they will probably all be using offsets of some description at some stage. There's a lot of skepticism about their use. So I think perhaps companies might find themselves with an outsized obligation to report on them to try and build confidence in their use, but noting also that the financial materiality might not be there.
Thanks, Fiona. It's interesting that you guys, both of you, mentioned about the materiality issues, and I think many people are wondering whether there'll be more carbon credits or a like mechanism uh, engaged by entities in the future. But before we go there, I think many of our audience would like to know more about carbon credits. Perhaps let's start with that first. So I guess many questions that we get sometimes is what are the differences between voluntary and compliance carbon markets or carbon credits? Is one considered to be more credible than the others? Perhaps maybe if can get Cameron to answer that question.
Yeah, look, I mean, Martin flagged there, obviously, we've got the safeguard mechanism. So from a demand side, we now have a very large regulatory market in Australia. And to put it into context, there's about 20 million Australian carbon credit units. They're the only ones allowed to be used under the safeguard mechanism. Roughly about 90% we're seeing is being accumulated or is expected to be used in future for compliance market use, right? So the voluntary market in Australia for Australian carbon credit units is actually quite small and not growing at the moment. We're seeing obviously corporations who are regulated use their certificates for that rather than kind of seeing substantial growth in the voluntary sector. There are international carbon units, gold standard VERI units, and old Kyoto units, and soon to be Paris units, which are also available. We do see more voluntary use in that sector, but with the safeguard mechanism, we're still only talking about, in the millions of VCUs and VERs being used in Australia. So really, in the last 12 to 18 months, we've seen a massive shift to a compliance market in an Australian context. And is one considered more credible than the other? I think the difference here, obviously, with the regulatory market, they're obviously being required to do it unless they reduce their emissions under the safeguard mechanism, they have to make good with an ACCU, so they're somewhat required to do it, whereas obviously voluntary surrenders of carbon units where they're done and reported are kind of above and beyond that. Now, one of the tricks with the Paris Agreement, though, is that international recognition, particularly of international units, is still being worked out. So there is a bit of a grey zone effectively right now around how we treat all of the voluntary certificates in Australia until we see those Paris rules that were just agreed on at the last COP come to fruition and work through how companies can see that those carbon certificate surrenders be reflected in international trade.
And so entities can buy carbon credits from other jurisdictions, right? Is that how we understand?
So there's nothing. So there's a number of voluntary recognition schemes in Australia. We've got a series of them, and companies have decided to go out on their own. We have until now run the Corporate Emissions Reduction Transparency Report. Highly recommend anybody go and see that. That gives you a lot more information than you'd see in an annual report, and shows a lot of better practice efforts by some of the leading companies in Australia on how to disclose your use of offsets and then what's in them. But look, companies can use international units. They just need to think about why and where. Whereas in an Australian context, Australian carbon credit units are now required to be used under law under the safeguard mechanism. So we've seen a very big difference emerge in the last 12 to 18 months across those markets. I mean, obviously the international units come from other certification bodies. The CER certifies the Australian carbon credit unit under Australian law. So quite a substantial threshold to cross if you want to get certificates certified by the Clean Energy Regulator.
Thanks, Cameron. And Tara, so what do you see in the market? Do you see many of your clients or perhaps entities been also getting international carbon credits, and as Cameron said, perhaps that trend is changing? What's your experience so far?
Yeah, we predominantly work with the corporate market and traditionally on the voluntary carbon market. And, there's no denying that every Australian business that comes to talk to us to buy credits, they want to prioritise Australian credits. They feel they are credible, that they know them, it's local, but there is that price barrier. And so when this is a voluntary option for them, we certainly see people opting for international units because they can have, I guess, the same impact, the same emission reductions by supporting international projects. When they are, trying to achieve perhaps it's carbon neutrality through the climate active scheme, that they have to hit a certain number of carbon credits to purchase to claim those offsets, and therefore they're opting for international units as well. But you mentioned, is one more credible than the other? I mean, I think it's important to note that they're just developed under different mechanisms, schemes, standards. No one is necessarily better or worse, credible, more credible, less credible than others. They're just developed under different standards and have a different label. And I think, there's even more than Cameron had mentioned globally. And what we need to see is kind of an overall standard of what that looks like so they can be more comparable and people feel comfort in that. And what we are seeing in the market at the moment is really that convergence between compliance markets and voluntary markets. And you look at CERs, they were developed under the Kyoto Protocol. That was a compliance unit. They've been purchased in the voluntary market for a number of years. We're now looking at, Corsair is a compliance framework. Both Vera and Gold Standard that were designed as voluntary units originally have been accepted into that program because of the standards that they uphold, that there is comfort that they have the credibility that is required for these compliance markets. And we'll see that through Article 6 as well, and what's just come out of COP. And again, Gold Standard and Vera and those types of credits can actually be leveraged in Article 6 transactions. Those mechanisms that are already in action will be kind of forming part of what countries will use as part of their crediting mechanisms as well. So I think over the coming years, we will continue to see this convergence between compliance and voluntary markets. But certainly at the moment, we see corporate buyers in Australia purchasing both, absolutely.
Thanks, Tara. I think when we talked about credibility, and many people have been relating that word to greenwashing with carbon credits lately, and we have seen those concerns in media and everywhere. And I think perhaps I would like to get your views, Cameron and Tara. What are your thoughts on these? Has carbon credit been used as a greenwashing mechanism?
I can go first if you like.
Yes, Tara, thanks.
Look, I think when we're talking about greenwashing carbon credits, are they doing what they say they're doing? There's kind of two lanes of thought. One is how are carbon credits actually being used in terms of claims that people are making, and then also the credibility of the actual project that they're purchasing from. So there's kind of two lanes of thoughts there. And interestingly, I mean, I think it's Trove Research that did this piece a little while back around people that are actually purchasing carbon credits are decarbonizing twice as fast as companies that are not purchasing carbon credits. So there's, I think, this misconception in the market that, if you're buying carbon credits, you're not doing anything about your internal decarbonization, whereas the research kind of tells us that's not the case. I guess when you're buying carbon credits, you're putting a price on carbon. And when your finance team see how much you're spending on it, they want to reduce that. They want to reduce that liability. So, I think in terms of greenwashing, yes, if you're just going to sit there and say, we've purchased carbon credits, we're going to offset and forget and not do anything else, that's not a sustainable way forward. That's not going to help the planet. But if you're using it as a way to compensate for your emissions as you're continuing to decarbonize internally, that's actually a very strong position, a climate leader position, really, because you're doing even more than a business that has set targets and is going to be decarbonizing over a 30-year timeframe. So the science really tells us that we need to do both from that perspective. We need to decarbonize internally as quickly as we can, and we need to compensate for our emissions to help the global economy decarbonize as fast as possible as well. That's in essence, what the carbon market is there for, is to help us to get finance to these projects that are having real life emission reductions now. Any other kind of misconceptions, I suppose, as I say, there's that look at, is the project doing what it says it's doing? And I think the market has gone through a huge process in the last kind of 12 to 18 months in particular around really increasing the integrity in the market, rebuilding that trust. But it's good to note that these methodologies, whether that's through the ERF, whether it's through Vera Gold Standard, these methodologies have been designed with scientists. They are continually improving, and that's always been happening in the background. And so we just need to make sure that we are being transparent about those continued improvements in all of these markets to make people feel comfortable that, you know, what they're putting their money towards is doing what it says it's doing, and putting that information publicly available. Vera Gold Standard, the majority of the international units in the voluntary market are very transparent. You can go and kind of see any document that has been listed under that project. And that is how, you know, companies like ourselves and also rating agencies can go and get that information to do an assessment to make sure that that project is upholding the standards and what is required to have that credit issued. And it's a journey, you know, the market is not perfect, but it's a fantastic mechanism really to help us get to where we need to be. And we just hope that, you know, we can help bring people along on that journey to continue to educate, be transparent, and as I say, make people have comfort that what they're putting their money towards is having those reductions that the climate absolutely needs us to make.
Yeah, I tend to agree, Tara. I think the kind of era of companies just offsetting themselves into a net zero position is already a bit of an outdated concept. We're certainly not seeing that anywhere as near as much now. And certainly with the safeguard mechanism, the message we always say is that, yeah, while you might be using offsets, the intent of this scheme is to see direct emissions reduction occur. Industrial emissions fall. And so really in that context, offsets now are and should be seen as a kind of transitional mechanism while companies build up the technologies to reduce their emissions, right? So we're asking a lot of them in terms of their emissions reduction, and where that's not easy to access, then offsets make a bit of sense to use as a transitional element. In the long run, don't forget what we're really looking for from an offsets market and offsets generally is supporting those industries that are almost impossible to decarbonize, so or very, very difficult or very, very costly, right? So you know, come 2050, the purpose of offsets should really be to counter the effect of emissions that we really have struggled to get rid of. And that's a very small group, right? Once we decarbonise the electricity sector, once we decarbonise industrial emissions with things like green steel, green hydrogen, all of those kinds of things. And so the nature of offsets and the role it's playing is definitely changing. And we have moved on from this concept of offsetting all of your emissions and calling yourself net zero. That's not what people are using them for now. They're using them as a way of transitioning. The safeguard mechanism in particular structurally makes that happen. It forces companies to surrender units if they can't meet their facility targets. But even more generally, through the reporting we've been tracking at the CER, yes, it is much more about offsetting where it makes sense to do so, but in fact, really direct emissions reduction being where companies are looking to put their money if it makes commercial sense to do so now. So that's it. And going to kind of more kind of what if one project is not a good project, or what if the kind of integrity and greenwashing questions around the schemes. I think at an individual project level, there is always project risk. Some projects fall over, some projects aren't successful. At the CER, for the carbon credit scheme that we run, we force projects through a lot of very, very high-level scrutiny gateway checks, and we get internal third-party audit in as well throughout the life of those projects. Plus, we chop a fair bit of the accus off the top that they never get for permanence risk and reversal risk as well. So we've got a substantial number of conservatisms built in to Australian carbon credit units, and we have a very rigorous process of checking. So in that regard, there is a substantial level of integrity built into those certificates.
No, that's interesting. I think it's important to making sure that there is some stringent process being put in place. As I mentioned before, it's such a newly regulated space, and I think many stakeholders are wondering the credibility of these carbon credits. And we also have heard that Telstra publicly declared that they have given up all the carbon credits, or they will be give up all their carbon credits and not going to have any transactions on carbon credits. What do you see with the future trends on with the carbon credits transactions? Cameron or Tara?
I think in general, companies are looking to secure long-term supply and backing projects right up the supply chain now. That's very different to a few years ago, where they're just relying on the market to deliver them. Certainly in an Australian context, large industrial emitters need long-term secure supply of ACCUs if they can't get their emissions down quickly enough. So it's a very large shift, and then also just the general shift in an Australian context. We're not buying many ACCUs anymore under Commonwealth contracts. The private sector is almost entirely taken over the ACCU market. And so there is just a general trend to the private sector taking on the Australian carbon market, if that makes sense.
Mm-hmm. Tara, do you have any comments?
And I think globally, we are seeing more entrants coming into the market, actually, perhaps not in individual entities purchasing as larger volumes as the entities that have been purchasing for a long time, but we're actually seeing a lot of new entrants into the market. So it is definitely picking up. We are also seeing, Science-Based Target Initiative is discussing around beyond value chain mitigation, or BVCM, of how you can incorporate climate finance and supporting projects outside of your value chain as part of your transition. So there's a lot of leading players globally that are looking at this very seriously, and we are seeing huge amounts of investments, definitely in Australia as well, with the safeguard mechanism. We're really seeing an uptick in the price. I don't know if you want to correct me on the increase here, Cameron, but I think its spot price has increased in approximately 20% in the last 2 to 3 months.
Sitting about $40. Yeah, that's right. Yep.
Yeah. So, we're definitely seeing a lot of movement locally in Australia and globally as well. And I think with the latest information to come out of COP and that kind of finalization of the rule book of Article 6, this really signifies the UN's endorsement of carbon markets as a key financial instrument for us to deliver on Paris goals. So I think from here, this is going to give us clear rules of how we can forge ahead and scale up the market globally. So I certainly think, we're going to see a higher integrity and kind of combined voluntary compliance market moving forward. So things I think are looking positive, at least from my personal perspective.
Okay, thanks, Tara. Now, I'm aware that Martin needs to leave in 10 minutes. So I'm going to pause here and I'm going to ask Martin and Fiona the next question that is based on the discussion we just had. What do you think preparers should include information in the disclosures in the annual reports? Martin.
Thanks, Eric. I was just smiling to myself. I'm yet to see or have any conversation with the company when the issue of voluntary credits as opposed to ACCU comes up. And everyone says, oh, we only invest in the highly credible ones, which I would give a prize to a company that said we invest in the cheapest ones we possibly can, because at least would be audits for honesty. To that end, I think what you want to see is disclosures. Fiona touched on this. You want to see if you've surrendered, what have you surrendered, what vintage? Ideally, enough information that people can go and check the kind of programs that you are surrendering against. I am familiar with one major company that is heavily reliant on offsets for its emissions reduction targets that actually specifically discloses each category and their verification number of the certifier. You probably want to see the scale of the expenditure, whether they're relying on being active in the market or they're developing their own. To Cameron's point, you are seeing more and more Australian companies, someone like Woodside, for example, who has been active in voluntary markets, now starting to try and put their hands on stuff they develop or have long-term agreements over. The the split between voluntary and regulated credits and their obligations, like the actual cost of their obligations under the safeguard mechanism if they're exposed. And then I suppose, and most companies in their sustainability reports do this, the extent to which they are reliant on offsets. Like where do they come into their reduction strategy? Is it a safeguard mechanism obligation, in which case we know they have to do it? Or is it, to what was being touched on, will it be for the hard to abate stuff once they've taken all the low-hanging fruit and nothing has arisen to allow them to abate those? But those are the kind of disclosures you need to see. But the more granular detail you can give around the actual value of the cost of the credits and what the projects are, the better.
Great, thanks, Martin. Fiona.
At risk of echoing, so we're interested in the financial and accounting aspect of things, how much is being spent of them, how much they hold. But we're also interested in how they relate to a company's decarbonisation strategy. And for that, we would like to see a lot more info about how they use them and what types are used. There was a 2021 report by McKinsey and the Task Force for Scaling Voluntary Carbon Markets, which suggested that demand for carbon credits could increase by a factor of 15 or more by 2030 and by a factor of up to 100 by 2050. So we're very keen for information to give us a better understanding of how they're being used and how much they cost. So I guess, specific information on the accounting side. I'd want to see a number of offsets being generated, bought, retired, and sold during the period. The cost, per tonne in relation to each of those activities. I'd also want to see what they currently hold in their portfolio of offsets and its value. It would be good to see removal-based offsets, perhaps reported separately from avoided or reduced emissions-based offsets. I guess in relation to credibility, I'd like to see whether the offsets, are domestic or international, whether they relate to carbon removals or avoidance, who has verified them, what the underlying project is, essentially anything that can help me get confidence that they're doing something in the real world and it's not just, a greenwashing or a carbon accounting exercise. We're also interested in how they relate to variable remuneration outcomes. So there's at least one ASX 50 company that rewards its CEO based on net emissions reductions. So emissions reductions after offsets are retired. We disagree with that approach, as they can obviously just use company funds to buy and retire offsets. They meet their net emissions reduction target and voila, they get a bonus. So
it's also a company, sorry to interrupt, Fiona, it likes to talk about how cheap its offset portfolio is in terms of the cost per tonne.
Yes. But I think, just there's the two sides of it, I think, accounting and financial, and also credibility in relation to decarb strategy.
Thanks, Fiona. Okay, so I think I'm going to move on to the next topic. Moving away from carbon credits for a bit now, we're going to want to understand a bit more about renewable energy certificates, which is another mechanism for carbon offsetting. So I'm going to direct this question to Cameron. If you can give us a bit more information about how does it work and why does it matter?
Yeah, well, first thing I would say is they're not technically offsets. They are a renewable energy certificate, which kind of entitles you to the claim that you used 1 unit of renewable electricity. And going to Martin and Fiona's points, things like vintage and location are really important here in that context as well. But they do operate in a similar way, right? So generally speaking, renewable energy certificates are restricted to, if you use them, if you voluntarily cancel them, like you would an offset, you can reduce your scope 2 emissions in your company. You can't use them to reduce your scope 1 emissions. There's no direct fungibility between carbon credits and renewable energy certificates. But having said that, they're a really powerful and effective way for companies to reduce or show that they're reducing their emissions. Like in our corporate emissions reduction transparency report, over the 3 years we ran it, we're going to close it down now that mandatory disclosure is in place. A bit of a forerunner to mandatory disclosure. the main way that we saw emissions reduction occur by corporations seeking to participate in that scheme that ran over the 3 years was through the use of renewable energy certificates, right? We saw quite a large jump to 40, 50%. Some companies using 100% renewable energy certificates for all of the electricity they consume so that they can claim they're 100% renewable. Why is this important in the context of offsets? So renewable energy certificates now, Tara flagged the price there of an ACCU. Well, the price of an LGC has now fallen quite substantially to below $30. And for those companies that were very savvy, they'd already signed long-term PPAs to access very cheap renewable energy certificates through long-term power purchase agreements. So what we're seeing is it's a very viable way for companies in the early days of showing that their emissions have reduced is to use large-scale generating certificates in an Australian context, right? And in a domestic setting, the number of ACCUs used is something like 1.1 to 1.5 million units a year voluntarily used. In terms of LGCs, we're up to 10 million a year. So, and we expect that to grow quite substantially. So in a technical sense, they follow the same rules, and maybe Fiona and Martin might be interested in setting their expectations around seeing the use of renewable energy certificates. But again, they have vintages, they have locations. What part of the country are you in? With the introduction of renewable electricity guarantee of origin certificates, the Parliament passed that law just last week. We will get time-stamped in the future. We will get time-stamped renewable energy certificates. So you can get to a very granular level about showing that you are genuinely 100% renewable. And the other great thing about those renewable energy guarantee of origin certificates, they are from 2030 onwards. We will certify renewable electricity in this country as long as it's needed now. The RET was to finish in 2030. So we've got continuity for renewable energy certificates. So we are seeing that as a very viable and likely way that corporations are going to access early kind of emissions reduction through certificates. And in fact, with the nature of the standards set for mandatory disclosure and what's in our National Greenhouse and Energy Reporting, you can now get recognised through what we call Scope 2 market-based accounting. So if you use those certificates, you can show that your emissions are lower. So we've got the kind of framework in place to show the renewable energy certificates and the emissions reduction. So it is a kind of complementary element to corporations. So they don't have to offset. They can use renewable energy certificates, particularly if they're a large electricity user, to reduce quite a lot of their emissions before you need to offset.
I guess it's another component where I think preparers may need to think about how to convey how they use renewable certificates in the annual report so that users can understand the intention and objective of it. I've got a Q&A question about, it's a bit very technical. It's asking about if a customer purchases carbon credits, which is considered as intangible assets in the customer's annual reports, and then cross-charges their carbon emissions to a supplier. In the supplier's annual reports, would this be classified as cost of sales, the carbon emission cross-charge? I'm happy for Deb to also provide some thoughts, but I think this is quite a specific technical matter. We don't want to provide advice, but I'll get Deb to provide some of your personal thoughts on this.
Yeah, no, it's a very specific question. If it's a good question, I think probably things to think about without giving a specific response. Does the supplier do a nature or function presentation of their P&L? Because if it's a function, you're not going to have cost of, if it's nature, you're not going to have cost of sales anyway. If they do have a cost of sales presentation though, then I think it's going to come down to what is their specific business model? Because the thought that I had there when reading that question was more if this, and I'm certainly not an expert in the carbon markets and all the different intermediaries that operate within it. But if this entity is more of an agent and they're just purchasing and passing on carbon credits, and I'd be thinking about, well, what do they control? And if they don't actually control anything, then I'm probably thinking principal agency, gross or net presentation. So what I'd be focusing on is one, what is the actual presentation method? And then two, what do they actually control?
Thanks, Deb. So yeah, so I think this is one of the examples on how complex it can be for carbon markets. And AASB staff, we welcome if you have any questions that you have come across on these technical matters, feel free to share them with us because we also like to share your examples to the AASB who sets the international accounting standards so that they can think about these issues while they're thinking about next plans on whether they should be developing a new standards for carbon credits. And also the AASB is working on an intangible assets research projects at the moment, and carbon credits sits right now possibly under that intangible assets project. So again, if you have any concerns, any feedback, please feel free to share it with us so that we can share with the AASB. Okay, so with all the discussions that we have, I'm going to ask Fiona questions about the renewable energy certificate that Cameron just mentioned before. Back to the start of the session when I did ask Fiona and Martin whether you have seen enough disclosures about carbon credits. I wonder whether you have come across to any disclosures from entities about renewable energy certificates. Did that cross your mind? That what Cameron was saying, more entities are now using renewable energy certificates to reduce the scope 2 emissions.
None spring to mind, but that doesn't mean none have done it. It just might be that I haven't come across them yet, but they don't sort of carbon credits and carbon offsets, as I noted earlier, tend to be more sort of qualitative statements of intent to use in sustainability reports rather than sort of featuring as an individual line item that would be, disaggregated into renewable energy certificates.
Thanks, Fiona. But what would you like to see in annual reports for when preparers prepare those information about renewable energy certificates?
Details, really. I mean, I guess representing investors, there's a few things we'd like to see at both the company level and the underlying offset level. So I guess zooming back a bit, at the company level, we like to look for a carbon offset policy. So some companies have them publicly available. So we'll tend to sort of look, I guess, more at that macro level of how they're intended to be used, the hierarchy that they will apply, considerations of quality. We often point companies to the Oxford offsetting principles, which is, a better practice framework around how offsets should be used. Again, at that higher level, we look for integrity around their use. We absolutely prefer to see real world emissions reductions being prioritised over the use of offsets. Perfect is sometimes the enemy of the good, but not all offsets are created equal. I mean, my understanding is that a small portion of offsets out there relate to the removal of emissions, while the majority relate to avoided emissions or emissions reductions. Whereas I guess intuitively, the only way to neutralise the impact of putting emissions into the atmosphere is to remove a corresponding amount of emissions from the atmosphere. Avoiding emissions and reducing emissions are absolutely good things, but they do not actually sort of negate emissions that are being created. Many companies are sort of saying that they're carbon neutral, even though the offsets they're using are based on avoided or reduced emissions, not necessarily removals. Going down a level, I guess, to the actual offsets and what we'd like to see, we look at issues like permanence. Are they permanent removals? According to climate analytics, for each tonne of carbon released into the atmosphere, around 40% remains after 100 years, 20 to 25% remains after 1,000, and up to 20% after 10,000 years. Whereas in Australia, I think permanence, and Cameron can probably correct me on this, I think permanence for offsets is determined to be 100 years, with some carbon offsets attributed to projects with shorter lifespans, but at a discount to reflect that.
Yeah, Fiona, you can choose, depending if you've got a land-based a sequestration project, you can choose 125, and we effectively skim off the top more that you never get a hold of if it's a 25-year period. That's right. The great thing about the permanence periods under the Carbon Farming Initiative, or some people refer to it as the ERF or the ACCU scheme, is there is a law that requires permanence to be upheld and a regulator there to make sure that permanence remains during those permanence periods. So we kind of get the extra control in an Australian context of having an enforcement and a law there to back it up, plus the conservative by removing those units. So there's a couple of really good controls in there from an Australian ACCU scheme perspective to support the integrity of those units that come out.
Yeah, understood. So yeah, I guess probably offset level, permanence, additionality, is the end result, is it, creating additional emissions reductions, not just emissions that would have been reduced anyway. For example, I think historically there's been criticism that the Australian offset market said some producers of offsets received accreditation, for not cutting down trees that were never intended to be cleared. And I guess the third thing we like to see is, verification. Third-party verification of offsets is an important component of quality. It provides additional comfort that there's no limited overestimation of the carbon impact at the baseline or actual emissions level, and that relevant effects are not double counted. It also verifies that the offset project has, in fact, been implemented.
Can I ask?
A shopping list there, sorry, but that's what we'd like to see. If everyone can sort it out, that'd be great.
I know I'm supposed to be a panelist, but I actually now have a follow-up question for you, Fiona. Didn't realize it was supposed to work this way. But in terms of what you'd like to see, I mean, there is a long list there. What is the most important thing in terms of, your top 3 things that you would like to see? What can we work on first is one part of the question. The other part is on this third-party verification, because, well, particularly the carbon credits that we work with, the standards that we work with internationally and here in Australia, all go through third-party verification. So are you looking for an additional third-party verification on those specific projects, or it's just simply that it's been through a scheme that does have third-party accreditation as part of?
I think if it's just been verified by, recognized framework or standard, that's fine. We're not sort of looking for additional layers upon layers of verification. I guess putting the investor hat on, the wish list is probably short-term around the financial and accounting side, just in terms of what's being used and what's being held and what the value is. I guess, representing long-term investors, the second is around the links to the decarbonisation strategy and how that looks in the long term.
Yeah, just writing those down so we can go and help our clients implement that.
So another question is, what challenges do you think companies may experience when trying to draw the link between what they do and disclosing what they do?
I think I understand the question. I think, we've come to an unfortunate position of green hushing rather than greenwashing now, that people are kind of so nervous about what they say, because if you say something and you've done it slightly wrong, people seem to come down on you. Maybe it's just better to say nothing at all. And that is a challenge that we're seeing with our clients at the moment. We have seen it's not necessarily a reversal of action. It's just a comfort of being able to talk about it. And, I think I said earlier, buying carbon credits as part of your holistic approach to the environment and tackling climate change alongside decarbonisation and actually implementing your decarbonisation strategy is a really positive thing. People shouldn't be scared to talk about that, but we've created this environment where people are, because as soon as you say you bought something, you go, well, you bought the wrong credit. Is that not better than not buying anything at all? What is the wrong credit? What is the right credit? And so I think, we do just need to be transparent, first of all, and really identifying why it is you've supported the project that you have, because it means something different to different people. From my personal view, I would much prefer to support an international project in a country that doesn't have the same finances that I have here in Australia to, maybe you're supporting access to clean water or biodiversity in that country, or empowering women and all the other wonderful co-benefits that come along with so many carbon projects globally. That's my personal preference, and that's something that means something to me. And if I was running a company and I went to purchase carbon credits to offset, that's something I'd like to focus on. But would I be called out in the Australian environment because I didn't support a local project? And so I think, in terms of helping people, it's being transparent, tell people why you're doing what you're doing, and how that fits into your wider strategy. Because, yeah, we need to encourage these actions. They're doing great things. We just need to give people the comfort that they can talk about it. And I think, we as readers for that need to encourage that, and not necessarily jump the gun and say someone's doing a bad thing when actually, it's come from a positive place. There's not many, hopefully none, but maybe some, that are not doing this from a good place. It is coming from a genuine place of trying to do something better. The more we disclose and the more we figure out, the more that helps people make informed decisions moving forward as well. The more we green hush and don't tell people what we're doing, we're not helping one another to progress things by keeping things close to our chest and not talking about it and not disclosing it.
Probably just adding to your point, I haven't seen, I don't think investors are yet at the stage where they're criticising particular carbon credits or offsets being used by companies. I think at this stage they're more at the level of lack of disclosures a red flag. So we're very attuned to the green hushing thing. It's really counterproductive. And the other, I guess, red flag is an unexplained sort of over-reliance on them in terms of decarbonisation strategy. I guess because that sort of raises concerns that they're not focusing on real-world emissions reductions and just sort of kicking that can further down the road.
Yeah, I think both domestically and internationally, I think what you're seeing is a bit of a generational shift. Fiona mentioned one of the methodologies before that's now closed, right? And even those methodologies that are now closed or have been revised, real action did happen. And in fact, based on the science of the time, we are seeing transformation of landscape with a lot of the projects we see and see very much on ground. We send people out to look at these projects and see what's happening. And the long-term objective for us is to make sure that real abatement occurs. And if it doesn't occur, then we kind of look to recoup the credits down the track, right? So and we're tracking these projects throughout, so that doesn't happen. But the long-term integrity is there, and the ACCU scheme, there's been a substantial amount of review. We know with the international schemes, there's a lot of scrutiny and review going on, and we're landing the new Article 6 arrangements right now and the new methodological arrangements right now. So we continue to improve, we continue to review and kind of open carbon markets to scrutiny so that you can provide that integrity. I think we'll probably see, yes, kind of as Tara was saying, it's really just about being clear about what you're using and where those certificates are coming from. Certainly in a regulatory sense, under the safeguard mechanism, we will be publishing what certificates were used from what entities, like that is part of the scheme. But at the same time, in an Australian sense, a carbon credit is a carbon credit in an Australian sense, and the scheme kind of provides the integrity as a whole around those units. So I think we will see kind of hopefully we'll see a move, as Tara's kind of urging people to do, back towards kind of a clearer disclosure about what you're doing and why. And it continues to evolve, right? This is a maturity question around what's appropriate. You can't, as Fiona, you're saying, you can't offset your way to everything now. It's not seen as an appropriate way to do it. You've got to really take direct action first, reduce your emissions on site, and then deal with the rest through offsets if that's what you choose to do.
Look, it's been a very fruitful discussion, and I think I'm conscious of time. I think we should draw an end. But before we finish, I'm going to answer two more questions. The first question is about whether the slides will be available. Yes, the slides, we will make them available. And then the other question is about, I have received a question because the AASB has just released yesterday and today, inviting researchers to submit research proposals as part of a tendering process. The question is, can we elaborate more about the proposals? Can we give example what we're looking for? Look, carbon credits is one of the topics that we think is important because the AASB is considering whether they should be working on pollutant pricing mechanism projects. So anything about carbon offsetting, even what Cameron discussed today about the renewable energy certificates, those topics will be interesting. It's very hard for us to provide the exact research questions, but any interesting topics at the AASB will be interested to look at them. So I've just got another more questions. Are there any insights into the reporting disclosures by organizations that generate ACCUs rather than those that use them? What kind of details are investors and stakeholders looking for? Going to perhaps I think we'll have a final conclusion comments about this question, and then I think Cameron and Tara and Fiona, feel free to also share with us what your organization will be doing in terms on carbon credits education or whatsoever. So the question is, are there any insights into the reporting disclosures by organizations that generate ACCUs rather than those that use or purchase them? And what kind of details are investors looking for there? I think Fiona had touched on them already before, haven't you, Fiona?
Yeah, briefly. So I know there's a couple of ASX 200 companies that do have their own projects, and disclosures are really low. Like, I'd be really interested to know sort of how much that's actually costing them with a hard-nosed investor hat on, if that's actually a cost-effective way for them to get carbon offsets or carbon credits versus through someone else developing a project, because that's not their natural sort of skill set. So yeah, probably for those that are using them, selling them, etc., I'd extend that request for disclosure to those generating them.
Thanks, Fiona. Cameron, would you like to share with us, is there any clean energy regulator?
Yeah.
Are you doing anything for stakeholders so that we are across what's going on with the carbon credits mechanisms?
Absolutely, Eric, and we passed over a question on nature repair markets. The CER is implementing the nature repair market scheme, and we will start certifying biodiversity projects. The way that's shaping up, and there's still a lot of work to go, it is really interesting to see that they are being tied quite closely in the way the methodologies work to carbon projects. So we probably will start to see that ability for carbon projects to also nominate and demonstrate biodiversity benefits coming off those specific carbon projects. So that's very exciting. We've got a second scheme just for biodiversity benefits, which is great. Then more generally, if you want to build your awareness of carbon markets, the Carbon Markets Institute is running the Corporate Climate Masterclass series right at the moment. I think there's still one more session to go on the 5th, but then if you want to subscribe to them, you can get access to the full series. That gives you everything to do with up to date. And we've got speakers from groups like intermediaries like South Pole, we've got government, we've got and companies, and talking about their strategies to actually accumulate ACCUs. So please go and check that out. And then if you're really interested in carbon markets, the quarterly carbon markets report that my team releases kind of is essential reading if you want to stay up to date on what is going on in a domestic sense.
Thanks, Cameron. Tara?
Yeah, shameless plug from me because it's quite topical, but South Pole is actually running a kind of carbon markets, what's happened in 2024 and outlook to 2025 webinar tomorrow. I believe it's at 1 p.m. If anyone would like the link to that, please feel free to reach out to me on LinkedIn and I'll send you the sign up link. We're very lucky that in this region we have a global Article 6 expert that's going to be on that call. So if you're interested in kind of what's come out of COP and that side of things, they'll be on the call as well. So good one to catch up on.
Thanks, Tara. And the session today is recorded and we'll be putting it available on our AASB website in the next 2 weeks. So if you missed the first half of the session, feel free to click on it and look at it again. So thank you everyone's time. Really appreciate your comments, Fiona, Cameron, and Tara, and also Martin, who left us 20 minutes ago for a personal reason. So thank you for your insights, and Deb, thank you for your presentation, and also Eka for your work on collecting the data on the carbon credits research project. So the next dialogue series will happen early next year in February. We'll provide more information in the future. So that's it for today. Thank you everyone's time.
Thank you.